Welcome to the Opportunity Zones and Private Equity Show. I'm Jimmy Atkinson. Opportunity Zone fundraising suffered a sharp decline in Q1 of this year. That is according to a recently released report from Novogradac and Company, but OZs are not alone in this fundraising turndown. Elsewhere, capital markets are freezing up quite a bit with rapidly rising interest rates and the banking crisis and general economic uncertainty all having impact. Joining me today to discuss the current state of capital markets is Nathan Wiggum, founder and president of EN Capital. And Nate joins us today from beautiful San Juan, Puerto Rico. Nate, great to see you. Welcome. Thanks for joining me on the show today.
Yeah, likewise. Thanks for having me.
Absolutely. Nate, for our audience of high net worth investors and advisors who may not be familiar with you and EN Capital, can you give us a brief introduction to your firm and what your role is there?
Yeah, absolutely. So Ian Capital is what I would say is a general commercial real estate capital advisory firm. So we do debt and equity placement and capital structuring for really all property types, all parts of the capital stack, all over the country. I sit in Puerto Rico. I have an associate that's based in LA, although now he's spent a lot of time in Barcelona. And then I have a couple partners in Miami. And so, when I say we look at anything, we can really look at anything and all property types, all the country. I've got deals I'm working on in California, Oregon, Florida, Texas, New York, here in Puerto Rico. So it's really across the map. And I founded this company in 2017. And I'm the president founder. It's my company. But I've been doing capital advisory and commercial real estate since 2006. So I've seen, I've gone through all the ups and downs, went through the last down cycle, which, we all got scars and stories from. But I've seen just about every kind of deal you can think of.
Yeah, 2006, when you entered, everything was going great. And then it turned not so great just a short while later, it sounds like.
Yeah, I thought the business was
0708.
easy. You just show up and, deals are easy and you make a lot of money. And, I had a couple great years and learned real quick that, when the market turns down, things change real fast.
Yeah, that was a tough time to get started because it gave you a false sense of security, and then all of a sudden the rug got pulled out from you. And you mentioned you're working on deals all over the country and a couple down there in Puerto Rico as well. I'll point out that we have a mutual friend in Jose Torres who's working on the Las Palmas deal down there in Puerto Rico, and he just recently presented his Puerto Rico Opportunity Zone Fund to our group at OZ Pitch Day. I know you know him and work with him. Is that right?
Yeah, absolutely. So I'm a partner in that deal. So he's a member of our GP through his Opportunities Zone Fund, which Jose's great. Him. He's got an excellent background in private equity. He was in the areas for a while. So he adds a lot of value and expertise just in general to our GP team, but he also brings these investment vehicles, one of which is the Opportunity Zone Fund, which allows obviously any option investors to come into our deal and receive the option treatment, which is very meaningful. Then he has another investment vehicle called a Puerto Rico Act 185 private equity fund, which is equity fund specific to Puerto Rico that has some unique benefits for people that live here on the island that want to invest in that deal as well.
That's great. Yeah, just wanted to shout out to Jose. Thanks, Jose. Thanks for hopefully you're watching or listening. I'll make sure I pass along this episode to you so you can watch this. Well, let's talk about. In a minute, I want to talk about what's happening with capital markets, the impact that economic uncertainty, rising interest rates, the banking crisis is having on capital markets. But first, what are capital markets? Nate, maybe you can give us a quick 101 crash course on what we
Sure.
need.
Yeah, that's a great question. And the answer is capital markets are really just a general term to describe uh, the debt and equity markets that are out in the overall economy that different companies and entities can potentially access and tap for capital when they're trying to, accomplish something. And in the context of our conversation around commercial real estate, that's everything from getting construction financing to build a new property, getting bridge financing to reposition an existing asset, or even just putting a term loan on your property. You own an apartment building, it's stabilized, and you want to go put a long-term mortgage on that. Well, you're going to go to a bank, a CMBS lender, the agencies, et cetera. But kind of all of all of those entities that provide capital to the commercial real estate world, we would consider to be kind of part of that broad capital market.
Good. And what I do typically, how I kind of fill in the capital markets, is I help alternative investment products, largely opportunity zone funds, raise equity from my group of high net worth investors and advisors, the audience for this show and the audience that has opted in with us at our two platforms, Wealth Channel and Opportunity DB. So I'm filling in a small part of the equity part of that overall capital stack that also includes some debt from time to time as well, depending on where the project is, which phase the project may be in. What about the impact that the banking crisis is having on capital markets with the collapse of Silicon Valley Bank and Signature Bank? How have you seen capital markets react to those events?
Yeah, so they're definitely reacting, and I'd say reacting as you expect, which is negatively. So we're seeing the overall capital markets and especially the debt markets definitely contract and become more conservative as far as what they're willing to do. A large portion of general commercial real estate debt is held by regional banks, and regional banks are exactly the types of banks that we saw in that collapse. Silicon Valley Bank was a very large regional bank, and along with Signature Bank, as well. And those types of banks are they're kind of the bread and butter for what I would say middle market term debt and construction debt to a certain extent to the commercial real estate world. So I'm in Los Angeles and I own a shopping center that's worth, I don't know, $30 million, something like that, and I want to go put a term loan on that center. I'm either going to go to one of two places typically. One is the CMBS market, which is commercial mortgage-backed securities, which is its own kind of separate thing. And it has pros and cons. If I don't want to go the CMBS route, and there's a lot of reasons why I may not, then I'm probably going to go to a regional bank. And in a big market like Southern California, you have quite a few regional banks you can go to. If you're in a much smaller market, maybe a secondary market or city in the Midwest or something, you probably have a small handful of regional banks you can go to. But overall, the regional banks are kind of a very common source of capital for that type of middle market term debt, and that is definitely contracting. And again, when markets are good, regional banks tend to be pretty active on the construction lending side. But when the market goes into a downturn, they tend to just do none of that type of lending. And that's what we saw through the financial crisis, and that's what we're starting to see now. So a lot of the bigger regional banks, like say Bank of the Ozarks, is a good example that was very active in construction in a lot of markets. They're really paring back, and we're seeing a lot of other banks doing the same thing.
Yeah, there's a lot of fear out there, and I think a lot of these banks are fleeing to safety, and the downside of that is we get the cost of capital has gone way up, and the access to debt has collapsed. What about rapidly
to be
rising?
clear, there are still a lot of debt sources out there. We're not in, say, 2009 when there was virtually nothing. I mean, no one had any liquidity. You couldn't get a loan, say a construction loan for anything pretty much. I don't care if you had $1 billion balance sheet from like 2009 to maybe 2011, 2012. Just no one was doing that. Today, there's still a lot of private funds and groups that are active. It's just that we are seeing an overall contraction in the market, and we're certainly seeing it pretty strongly in that regional bank world. And I think we're going to see more of that because regulators are I think really putting the squeeze on those banks. But there are still a lot of other options that are available. So I want to be clear: capital markets are contracting, but there is still capital that's available for good deals and good sponsors at a cost of capital that makes sense.
Sure. Rapidly rising interest rates also has had a pretty big impact. We were in a very low interest rate environment for 12 or 13 years or so before interest rates started ticking up. The Fed started increasing interest rates. When was that? About 9 months or so ago, I guess, middle of last year.
About a year ago.
Correctly, yeah, about a year ago. Okay. What impact has that had? The cost of debt has increased. Has it made the cost of equity by comparison look a little bit more affordable?
So it is absolutely pushed up the cost of debt. I mean, SOFR, I think today is at like 4.8. It was 25 bips for forever.
Yeah.
right? And so that's a monster increase. I mean, I think this is the fastest Fed rate hike in history ever. It's not the fastest, it's certainly one of them. And so that has really kind of flipped a lot of things on their head. I mean, that's the reason that Silicon Valley Bank imploded, which is a whole other discussion about how they were managing their assets and their balance sheet. But in the commercial real estate world, absolutely. So your average cost of a construction loan today, I mean, even from so most banks are doing construction debt. There's a handful that still are, but they're pricing, prime plus 1.5, prime plus two, prime's at 8% today. So I mean, that's a 10% loan from a bank, which most people, we just haven't seen that for like 20 years. And it's definitely making, obviously you got to underwrite that finance expense into your project cost. And that increases your cost basis, which is going to lower your overall returns. Because we're not seeing, at the same time, we're not seeing a huge increase on the revenue side, from rents or anything like that. So certainly putting the squeeze on some deals. And, I think there was just a lot of deals getting done over the last 10, 15 years that I wouldn't necessarily say were fundamentally sound relative to the dynamics of the local market. And we're really just driven by the fact that capital was so cheap and so readily available. And, examples of that would be there was a lot of deals that were done in secondary, called Sunbelt markets. And I'm talking like, Phoenix, certain parts of Texas, et cetera, and I'm talking about multifamily repositioning deals where people were underwriting exit caps, for that type of deal at Southern California exit caps, like 4%, right? And using really high leverage floating rate debt to fund those transactions. And obviously that cost of debt has gone up substantially. And a lot of those deals just don't make sense anymore. And so
They
I
could
think
get
we're going
away
to
with it. They could get away with it up to a year or so ago because the cost of capital was so cheap, right?
yeah, exactly. Yeah, you had a really big margin of error
Yep.
because money was so cheap, and you could probably, if you ran into some trouble, you'd have refinance options and from other lenders and other things like that. Those are kind of all going away, and so I think there's a lot of deals in those markets that were probably heavily over leveraged that now are going to be seeing a pretty good amount of distress this year. And I also think there's a lot of lenders on the private debt side, and I won't name anybody, but definitely have a few key ones in mind that I know are being very aggressive. And I would bet a lot of money that a lot of those lenders have loans in their balance sheets that they would really like to get rid of.
Sure. And I think that creates a big opportunity for people with capital. I want to talk about that with you in a moment. That's where we're going with this episode, is the potential opportunity that's out there for the taking for high net worth investors and other family offices and advisors, other folks who may have access to capital. But first, what about I want to talk about the capital stack in general for an average type of commercial real estate project, I guess. Have you seen a shift in debt to equity ratios recently? You may have in the past been able to put more debt, more leverage into a deal. Has that come down recently because of
Yeah,
cost of debt rising so much?
yeah, absolutely. So we are seeing, the lenders that are still active in the marketplace are definitely being more conservative on leverage. That's both just because kind of two reasons. One is they just fundamentally want to be in a lower leverage position given concerns about the market, and two, it is because you have the higher cost of debt. There's only a certain amount of debt burden or debt load that a deal is going to be able to support at the end of the day. And so you have to, when you're talking about bridge or construction debt or anything that's transitional, that lender, the only thing they really care about and think really hard about when they're analyzing a loan is how do I get paid off? And getting paid off is usually either one of two scenarios. First one is sponsor builds the project and sells it. That pays me off. Or what's more common is sponsor builds it, he wants to hold it, and he's going to refinance me out with conventional debt. That debt's going to come from regional bank, an agency if it's say a multifamily property, or potentially a CMBS lender. And so they are going to underwrite to that takeout. And so they're going to look at the deal and say, okay, once the asset stabilized, given these, the higher cost of capital world that we're in now, at a higher interest rate, loan amortizing on a conservative schedule, that this deal will support a term loan of X dollars at some minimum amount of debt coverage that we think is reasonable. And we are certainly not going to provide any kind of bridge or construction loan that is greater than that. In fact, we want some margin of error. So we might say, look, the maximum loan we're willing to provide on this property is maybe 10% or some margin below what we think that takeout financing is. And so given all that, I mean, that kind of methodology has just put most lenders in a position where they're definitely contracting leverage compared to where they were a year ago.
Got it. Let's take a look at multifamily for a moment, because seems to be the biggest asset class in real estate. What was typical a year ago for the amount of leverage you might have on a multifamily deal, and how has that changed to today? Was it like 60-65% could be typical, and now it's
you had lenders being real aggressive. I mean, we have groups we go to that would give us 80% of cost financing on multifamily construction. I mean, you could layer sub debt on that. So we had groups going up 80%. We had a group that's one of the largest mortgage REITs in the country. We know very well. They had a program where they were saying, look, we'll provide 90% of your entire project cost as a debt instrument, and that gets some participation. So they give you, basically 90% at a pretty good interest rate on as debt piece, and then I think it was something like you give them 25% of the equity off the back of the deal, and you're good to go. So those programs have definitely, either gone away or come down. For ground up multifamily, or called value add multifamily, I think a reasonable debt assumption today is probably around 70% of cost. You might still be able to push that a little bit, but that's what I would be underwriting to. And there are still some options for layering in sub debt, which is going to be mezz or preferred equity or even PACE in certain markets. So you can achieve higher leverage, but you still have to go through that same methodology I described of underwriting to what that takeout financing is. And that takeout financing has to underwrite to not only repay the senior, but any sub debt that's in there as well. So you're still kind of constrained by what the overall cost of capital across your entire debt stack would be between your senior and junior lenders.
Good to know. That's a little bit higher than I had thought, actually. So that's good to know. You mentioned PACE. We've talked about PACE, I think maybe once or twice on this podcast in the past. There's some OZ deals that I've spoken with that are doing some PACE financing. Can you tell us a little about what that is?
Yeah, absolutely. And I actually used to be a PACE lender before I founded Ian Capital. I ran business development for a PACE lender out of San Francisco for about a year and a half. And yeah, PACE is a really interesting, unique product. The acronym stands for Property Assessed Clean Energy. And the reason for that is because it was originally created in 2008 in Berkeley as a way to finance community solar projects. It since has grown beyond that. What PACE is a legal framework that is established by state statute, and I think 39 or 40 states to date have it, that allows a private market lender to lend against real property, but secure their interest in that property, not through a traditional mortgage, but through a voluntary special property tax assessment. And the loan is actually repaid as a line item on the property tax bill. This has a lot of advantages to the property owner or borrower. One is it comes in as a tranche of capital in your capital stack. Typically, PACE maxes out at 25 or 30% of value or cost, but it comes in tandem with your senior lender. But because PACE is repaid through the property tax bill, it's actually senior to the senior. We call it super senior. And so, because if you don't pay your property taxes, you can go to tax them, right? And that's senior to everybody. And so because of that, the PACE lender can provide debt at a very low cost, even relative to what your senior lenders are charging. And so when you combine, PACE to your debt stack, you're typically adding leverage and reducing your overall cost of capital. So borrowers tend to really like it. The trade-off is that because you're doing it through this very unique structure, the PACE funds need to be used to fund building improvements that serve the public good. And started with energy, so anything that is energy efficient, on-site renewable generation, you're putting in a solar system or something like that, all those things are definitely PACE eligible. But it's kind of grown beyond that. So for example, in California, seismic improvements are PACE eligible. In Florida, hurricane proofing is PACE eligible. I've been working hard to try to bring PACE here to Puerto Rico because there's a lot of applications for PACE here beyond the stuff I just described. So it's a really unique product. I think there's a lot of benefit to it, but it can be very tricky with how it interacts with the senior lender, and you need to have a senior lender that is PACE friendly. there's over the last few years, there's been some debt funds that have come to market that offer both senior and PACE financing through a single fund. I think if you wanted to explore PACE, that would really be your best option because, like when I was originating PACE loans, the biggest challenge we had, and this was also 2016, so this was a really new product, and no one even heard of it. Um, but getting senior lenders at that time comfortable with it and being willing to actually sign an acknowledgement, which allowed us to fund, was really challenging. So if you're going to an entity today that can provide both the senior and PACE, from a single shop, then you don't have that issue and you can get things done much more efficiently.
That's great. I didn't mean to derail the conversation too much. I just think that's interesting. We haven't had an episode that's covered PACE in detail. I might have to have you back on the show because I'm sure we could probably spend 30, 45, 60 minutes even talking just about PACE financing. It's a fascinating topic. We should do a deep dive at some point down the road, but we'll leave it at that for today. Getting back to our main discussion, though, on the state of capital markets, some of the turmoil, the freezing up, and distressed debt you mentioned a few minutes ago. All of this potentially is leading to an opportunity for high net worth investors or other sources of capital. What is the opportunity that is posed here?
Yeah, absolutely. So, and I'll add something to that, which is something like 1/3 of all commercial real estate debt is floating rate debt. A floating rate is, of course, exactly what it sounds, right? Your rate's not fixed, it floats with the market. And floating rate debt is so ubiquitous in the industry because we had low interest rates for so long, right? I could go out, I have a multifamily portfolio, I can go get a long-term amortizing floating rate loan with probably some long period of interest only. So I'm not even paying down principal. Like let's say I did a 10-year loan with 5 years IO. Well, that, just boosted the cash flow off my portfolio tremendously, which was created a lot of wealth and cash to distribute to investors for those types of groups. Now, since interest rates have gone up so substantially over the last year, any floating rate debt that did not have some kind of a interest rate hedge instrument, which could be a credit default swap or an interest rate swap, or an interest rate cap, something that you acquire typically when you originate your loan. Well, all those loans now, you might have had a loan that had a 4% coupon on it, and now you're paying 8.5%. And that unless your properties, your portfolios were just throwing off tremendous amounts of cash, it's quite likely that you're either underwater or you're barely breaking even, or you might not even be satisfying, the debt coverage covenants of your loan. And, you could be sitting in technical default. So, what all that means is that this rapid rise of interest rates is directly impacting, basically 1/3 of the debt that's out there for the overall, U.S. commercial real estate market. And so we're going to see, and we're actually starting to see a lot of, potentially distressed deals and distressed loans. But that translates directly into an opportunity. So, anyone who is well positioned to have two things. First, the most important one is access to deal flow. And access to deal flow means you have relationships with the lenders and entities that are holding these loans on their balance sheet. Most lenders, I say most, really no lender is going to be advertising to the market that, hey, we got a bunch of bad loans, that we're willing to sell at a discount just to get rid of them. You should give us a call. No one's going to say that, right? So you need to have relationships and contacts with these groups that trust you and are willing to, let you know. I mean, we're starting to have groups reach out to us saying, hey, maybe we should talk about a couple of deals that we're looking at. So again, having access to deal flow, super important and challenging. And then secondly, you need capital. So a lot of these opportunities are very quick moving. It could be something like, hey, if you can acquire this note at a, very quickly from us, because we're looking at increase our liquidity as a lender, we'll sell it to you at a pretty substantial discount. That discount might be 10%, 20%, 40%, half. It just depends on the deal and how distressed the situation is and how in need of liquidity that lender is. And so if you're in that, again, position to have access to have those conversations, but also have dry powder that can be deployed relatively quickly, you're going to do very well. And in the last cycle, there's a lot of groups probably that did say from 2011 through like 2013, 14, that bought a lot of distressed paper at really substantial discounts, and they created a tremendous amount of wealth for themselves. And I think this cycle is going to be uh, very similar, potentially larger, because this impact of increasing rates has been so quick and so dramatic. And also, I think this cycle is going to move a lot more quickly than the last one. There's still a lot of liquidity in the system, and we're just in an environment where business just seems to be, the pace of uh, deal flow in general has just accelerated so quickly, probably due to technology and other factors, but things are just moving fast.
Well, I've got a few follow-up questions for you. It sounds like a great opportunity if you're able to take advantage of it. If I'm a high net worth investor or a family office or an RIA that has a lot of dry powder sitting around, but maybe I'm not quite sure where to turn. I don't know who to talk to. What's the best way I can take advantage of this opportunity? Who should I reach out to get access to deal flow?
Yeah, so that's a really good question, and I would say, um, unless you are an expert in loan workouts, restructuring, you know, doing these types of deals, I wouldn't try and do them yourself because they can be relatively complicated. And depending on what state you're in, what jurisdiction, what the foreclosure process is like, is it judicial, non-judicial, et cetera. Um, it can be complicated. So what I would recommend is you'd want to find a platform that has all of that expertise and a lot of experience, in house through their team and sponsorship, and potentially invest through a group like that. Because again, you need access to deal flow, and you need to be working with a group that has that, and they need to know how to do these deals. And so you want to be working with a group that has deep expertise on that front. So for us, we actually have a partnership with a platform exactly like that, based in Miami. The sponsor has, he was in the workout group at a local bank in Miami, I think for like 11 or 12 years, ran $1 billion of their portfolio in the last down cycle of restructuring his workouts, REOs, et cetera. And now has his own platform that he sponsors. And so we're working very closely with him, both on originating these deals through our network. And so we have a lot of interesting deals we're working on. For example, we're looking at acquiring a $50 million note on a distressed condo development in New York City. We're looking at a note on a hotel in Florida, among a bunch of other things. And then we're also, bringing capital to this group, basically at the fund level. But that's what I would recommend. You want to identify whether it's a group like that or someone else. But I think the best near-term opportunity to invest in commercial real estate over the next, call it 18 to 24 months is going to be on the distressed side, primarily distressed debt, maybe in certain cases at the distressed asset level side. But again, unless you are an expert distressed note investor, you should be investing in a fund or through a platform, maybe on a deal by deal basis where they have that expertise.
Really good insights. Great advice there, Nate. Hope my listeners and viewers were listening to that, and they can reach out to you, or if they know anyone with that type of platform, they can start taking advantage of this opportunity potentially as it springs up over the next what you said, about 12, 18 months or so. You think a lot of distressed paper will be available?
I think in the second half, so we're starting to see deals now, but I
Okay.
think the real kind of deluge of deals is coming, that wave, because there is a big wave of maturities on short-term floating rate bridge debt that is coming towards the end of this year and into next year. That's when I think we're going to kind of see, a lot of those deals coming down the pipe. But like I mentioned earlier, I think I think it's going to be a fast-moving, tall wave that's going to go pretty quickly. So you got to be, in the right position with capital to surf that wave. And if you're able to do that, you're going to do really, really well. If you're not in that position, you're going to miss it.
Right on. Well said. Well, let's shift gears for a little bit here as we kind of wind down our conversation, wind down this episode. I mentioned at the top, you're in San Juan. You lived in Puerto Rico for the last several years, I think now. What is the real estate market like down there in Puerto Rico?
Yeah, Puerto Rico is interesting. The market is still quite strong. Puerto Rico is a little, I mean, it's a U.S. territory, of course, but it's a little insulated from the U.S. and that our capital market here is kind of insulated to Puerto Rico to a certain extent. And there's good and bad things that come with that. Bad thing is I say we have 3.5 banks, and Banco Popular is more than half the market. And we got two others, and there is a fourth bank that's relatively small, but it's actually will probably run very quickly over the next few years. But those are really your only options for any kind of bank debt. There's a few private money debt funds here that are very, very sophisticated, very good, and we know them well and are doing deals with them. But for the size of the market, there should probably be something like 10 or 15. And so the capital markets here are constrained. But what that means today is that this increase in interest rates isn't really affecting the market here that much because it was such a credit constrained market. The cost of debt was always higher here than it was in the mainland. So even a year ago, a construction loan from a bank was probably 8%, maybe 7.5%. Today, it's that 9.5% over prime. So yes, it's gone up a little bit, but we haven't felt the full brunt of 450 bips of increase. We've kind of felt locally here more, I would say something like 2 to 250. So that hasn't really cooled the market off. And on top of that, because Puerto Rico was in a depression for so long, and property values here got so depressed relative to where they should be, that if you're doing any kind of a development project here, or repositioning, buying an asset to convert it to a hotel, or maybe something small, I'm buying a 4-unit, I'm going to turn it to Airbnbs, whatever that is, right? Your yield on cost that you're looking at here, just kind of by default, because of where your acquisition cost is going to be, was probably already north of 10%, maybe 15, maybe 20%. And so given that, the deals you're going to do here can handle just overall a much higher debt burden than a lot of stuff you would see in the mainland. So that's a long way of saying, the market is still very good. We're actively doing deals here. As I mentioned, I'm a partner in that development project that Jose is a partner in. And we have other deals that we're working on here. So this is actually, so I said earlier, I think the best place to invest in commercial real estate over the next year and a half or so is going to be on the distressed debt side. And I think that's very much true, really all over the mainland US. Here, I still think there's a lot of interesting opportunities here to, for hospitality, industrial, housing, et cetera. That still make a lot of sense.
Well, that's great. Nate, it's been fascinating catching up with you, talking with you. Really appreciate your insights into the capital markets space and the commercial real estate space as well. Before we go, just to zoom out, wanted to get your thoughts on what do you think are some of the most powerful trends that you see playing out over the next few years across the commercial real estate industry from a global macro perspective?
Yeah, that's a really interesting question. And there's a lot of ways to answer that. The one that I'm personally really interested in and very bullish on is all of this activity of manufacturing coming back to North America from China. And we're seeing a tremendous amount of activity on that front at all levels of the supply chain, and products. So obviously you have everything that's going on with chip manufacturing through the CHIPS Act, but a lot of other things as well. And I actually spend a lot of time in Mexico because my wife's from Mexico. So we spend usually about 4 or 5 months out of the year there. So I see kind of what's going on there. And I think that the northern Mexico, call it Texas Triangle area, and then kind of the U.S. Southwest, is going to do phenomenally well over the next 10 or 20 years, as most of those supply chains and manufacturing activity, leaves China, comes back to the U.S. And anything that is not so sophisticated that has to be manufactured in the U.S. is going to get manufactured probably in northern Mexico. And so I think that's going to create a lot of industrial real estate opportunity, on both sides of the border. And I'm interested in looking at both sides. In Texas, I think, all your warehousing distribution activities or types of property types are going to do very, very well. I think demand is going to just be sky high for a really long time. And then in Mexico, I think, if you're willing to, do a deal in Mexico to get a higher yield, which you can, I think there's really interesting opportunities on, say, the build to suit side or just general industrial that's going to be leased to U.S. and Canadian companies. In fact, I'm looking at a deal right now in Querétaro with a local developer who's looking to build about 400,000 square feet, and the target tenants will mostly be U.S. and Canadian firms, and you have dollar-denominated leases, so you're not even taking currency risk. But if you're going to just another country like that, you're going to command a higher yield on cost than you would in the U.S., but you'd have very good credit on the tenant side. So I think all those opportunities are really interesting, and we're just going to see a lot more of those over time.
Great thoughts, Nate. Hey, Thanks again for sharing all of your insights today. Before I let you go, can you tell our audience of high net worth investors and advisors where they can go to learn more about you and EN Capital?
Yeah, absolutely. So website, encapital.com. It's funny. I when I created the firm, I called it EN Capital. But now that I'm in Puerto Rico, I'm thinking I should call it In Capital, which was totally unintended, but I think works. But yeah, you go to my website, encapital.com, or you can find me on LinkedIn. I've got like 20 something thousand LinkedIn connections. So you just punch in my name and I'm going to pop up pretty quick.
He's a well-connected man, ladies and gentlemen. We'll be sure to link to his website, encapital.com, and his LinkedIn as well on our show notes for today's episode, which you'll be able to find, as always, on our website at opportunitydb.com/podcast. Please also be sure to subscribe to us on YouTube or your favorite podcast listening platform to always get the latest episodes. Nate, thanks again so much for joining me today. Really appreciate your time.
Absolutely. Thanks a bunch.